A report by global ratings agency Moody's downgrading India's outlook to negative from stable has sent shockwaves through business and economy circles. Moody's has cited the possibility of economic growth remaining materially lower and a rise in debt burden as one of the primary reasons for the downgrade. The government of India has responded by saying that fundamentals of the economy remain strong with low inflation rates and low bond yields, one of the fastest growth rates in the world as well. Coincidentally, the downgrade in India's outlook comes on the third anniversary of the demonetization move that some believe has contributed to the slowdown the Indian economy now finds itself in. So what was the reasoning behind Moody's downgrade and how much does it really matter in the bigger picture? To speak on this, we have a fantastic panel of experts lined up for you, but I will start by speaking with William Foster, VP Sovereign Risk Group at Moody's Investors, joining me now from New York. William, thank you so much for speaking with us here at ET Now. Let me begin with one line from the report where you say the prospects of further reforms that would support business investments and growth at high levels and significantly broaden the narrow tax base have diminished. This is also one of the reasons cited for the downgrade. Why do you think the prospect of further reforms have diminished when we've seen a slew of announcements from the government of the day to try and pull India out of the slowdown it finds itself in?
Well, first I want to clarify that the rating itself, the Baa2 rating, has not changed. That has been affirmed. Yes. It's the outlook which has changed to negative. And really the basis for that was we're seeing a much more pronounced slowdown in growth than certainly we'd anticipated 2 years ago. Real GDP growth has fallen from about 8% 5 quarters ago to 5% today, along with nominal GDP growth, which has really come down as inflation has been contained. What the challenges that presents to India more broadly is that with lower growth, particularly lower nominal GDP growth, you have lower tax buoyancy, so your ability to collect taxes and revenues goes down, which makes it more challenging for the government to meet its fiscal deficit objectives and broader fiscal consolidation, bringing the debt to GDP ratio down. And at the same time, it makes it very difficult to create jobs and to bring the economy up to a stronger, more sustainable growth path with rising incomes. And the reason we mentioned what we had in terms of reform outlook is largely because there have been many reforms that have been passed that were very important. Those are the basis in large part for some of the positive movement we've seen over 2 years in terms of our view in the credit, GST, the Insolvency and Bankruptcy Code, the implementation of the Fiscal Responsibility and Budget Management Act. But what we have not seen is really successful implementation of those various reforms to the degree that they've had a material impact providing positive support to the economy. We may see that over the longer term, yes, but that's a challenge. And more importantly, the other reforms that we need to see, just to conclude, would be really in the factors of production. So things like labor and land reform that would really have a meaningful impact on the attractiveness of India as an investment destination and really drive growth much higher at a sustainable level moving forward. We think the prospects for those are more challenging today because the previous series of reforms have not been fully implemented.
So if I understand correctly, the concern is more with the implementation of reforms in the past, which raise questions about how further reforms, if brought on, would actually be implemented, more than the government actually going ahead with a fresh slew of reforms, because there seems to be no big challenge in terms of the will to bring in reform.
The government is clearly focused on these issues. They absolutely have moved forward with a series of important reforms over the last several years. But yes, the challenge really has been implementation, the effectiveness of the reforms once they've been passed. And that's where we're really seeing a gap between intention and outcomes. And that's really weighing on the economy right now, in addition to the challenges that you're seeing with regards to the NBFC sector and other things that are new. These implementation challenges are really weighing on the effectiveness of the intended reforms.
Does this also, tie in with another statement that's been made in the report, where you say although Moody's expects these measures to provide support to the economy, and you're referring to recent measures, they are unlikely to restore productivity and real GDP growth to previous rates. Is there also a question of implementation of reforms that have just been announced? Or is it that they're too shallow to tackle the depth of the problem?
We think at this stage of the evolution of the Indian economy, the reforms that were passed certainly need to be followed through in full, but there does need to be a next wave of important transformational reforms to really bring growth to what had been higher levels in the past. And that would be, again, tackling things like more flexible labor laws, improving or easing the access to land, better infrastructure. All of those things would improve the competitiveness, along with the tax reforms that were just passed for corporate taxes. You need to see those material changes on the factors of production to really bring the growth path higher at a sustainable rate.
The corporate tax reforms that you talk about have also raised concerns on the fiscal deficit front, isn't it? And not just the corporate tax reforms, but others as well. And, the report talks about India missing the target. Now, how big is that as a concern in the bigger picture? Because there is a point of view domestically as well that maybe the fiscal deficit targets need to be relaxed for some time to enable India to pull out of the slowdown.
Well, there's certainly trade-offs, right, in terms of the short-term impact on the fiscal deficit versus the longer-term impact on competitiveness and potentially improve revenues in the future if economic activity really picks up. So this is, you can't look at it in isolation. You have to look at it both in the near and the longer term. But I think what we've been seeing over the last few years is consistent slippage from the fiscal deficit targets. It's not just this year. It's been a consistent thing over the last few years that's really built up and strayed from the intended fiscal deficit roadmap and the targets that had been set out by the Fiscal Responsibility and Management Act.
Okay, I just want to focus on one more aspect from the report that I thought was very important and didn't get as much play is when it talks about the costs of climate change and pollution on India's outlook. I think those are some factors which are underplayed generally in the debate on what's happening with the economy. Can you elaborate on those points and the concerns there, William?
Sure. The environment is a very important consideration. Obviously, ESG, environment, social governance issues are something that we're following very closely. And in India, obviously, you see the climate risk and environmental risks are material in the sense that pollution obviously is very high. You can see that obviously in cities like Delhi. There's issues around water scarcity, water management. And over time, if these are not addressed in full, they certainly have an impact on the economy and social welfare, people's ability to contribute in full to the workforce as healthy workers. And ultimately, that starts to weigh on the economy through various channels and productivity, but also consumption and the attractiveness of India as a destination for foreign investors and for domestic investment. So those are just some of the implications if these environmental issues aren't addressed over time.
Now you've listed reasons or factors which can contribute to a downgrade in rating in the future, or an upgrade in rating in the future as well. What do you see as a timeline, William, for these factors to actually improve at the current pace, in the current situation, with the reforms that are currently on the table?
There's no set timeline. This is really something just to signal that the pressures over the last 2 years have really built up toward the negative downside. And there's certainly sufficient time for the government to address these, over the looking forward, but there's no set time horizon under which that will necessarily take place. But the challenges are clear. It's really to get growth back on track at a sustainable level and to use that higher growth to contribute to fiscal consolidation.
I must ask you about demonetization, because the year after demonetization, Moody's, of course, upgraded, India's ratings. And now we've gone and cut corporate tax rates, and there's a downgrade in outlook. There is a view that demonetization may have contributed to the current situation. Where do you stand on that?
It's a really good question. And fundamentally, one has to ask themselves in isolation, what was the impact versus the accumulation of various reforms. Our view is that demonetization was the beginning of a series of measures that ultimately have weighed on consumption. So it was demonetization followed by the GST implementation, and then ultimately what banks have been dealing with high NPLs, and then more recently the NBFCs, which have been important providers of credit, particularly to the retail segment when banks lending had slowed. So all of these things together have really had an impact, along with lower food prices, which has had an impact on the rural sector in particular, and increased farmer distress because of the negative terms of trade shock. And demonetization contributed to that, but there are many other factors that have led to where we are today.